Near the peak of the last Bitcoin cycle in 2021, Jack Dorsey tweeted that hyperinflation was going to change everything and that it was already happening. In the short term, he was wrong. There was no hyperinflation in 2021. In fact, that tweet marked almost the exact top of the Bitcoin bull market. Holding dollars over the following 12 months was actually a good trade, as nearly every asset class collapsed in 2022, especially Bitcoin. And by definition, hyperinflation is roughly a 50% monthly debasement rate, which is extreme and rare. Of course, that didn't happen. Still, while Jack was wrong on timing per the technical definition, I think he was directionally right. We are in a long-term monetary shift where Bitcoin continues compounding at roughly a 50% CAGR over 16 years, while fiat currencies slowly lose purchasing power against superior money. When you study the history of fiat currencies, there's a pattern that becomes hard to ignore. Hundreds of fiat monies have existed throughout history, and most of them are worth zero today. What makes today different is that this is the first time practically the entire world has been running on a fiat monetary experiment at the same time. That experiment is only about 54 years old, and when you study why so many fiat money systems failed, you can see three recurring tipping points. First is fiscal dominance, where governments run massive deficits, and the old playbook of the central bank raising interest rates to slow growth and inflation no longer works. When debt is extreme, raising rates actually increases government spending through higher interest expense and can accelerate the problem instead of fixing it. This is what Lynn Alden means when she says, "This train has no brakes." Second is the breakdown of the bond market as a real free market. Since 2008, the central bank has increasingly become the buyer of last resort for US Treasuries as capital moves into scarcer, more inflation-proof assets like stocks, real estate, and gold. Third is the collapse of public confidence in the economic system itself. This third point is especially visible today. The University of Michigan Consumer Sentiment Index is near historical lows, while the S&P 500, NASDAQ, and Russell 2000 sit near all-time highs. That disconnect is not normal for healthy monetary systems, but it is very common in late-stage fiat regimes and highly inflationary emerging market currencies. Stocks go up in nominal terms, while regular people feel poorer and more uncertain about their future. All three of these signals have historically appeared near the end of hundreds of fiat currencies. Now, that does not mean hyperinflation is inevitable or desirable. In fact, the best outcome is what we already have seen for the last 16 years. The dollar continues to exist, while Bitcoin compounds at an extraordinary growth rate and steadily absorbs capital. The system today is becoming more fragile in both directions. As governments, corporations, and individuals take on more debt, the system becomes more sensitive to both inflationary shocks and deflationary crashes. In a deflationary panic, we now know that policymakers will respond faster and more aggressively than ever before, as we saw in March 2020. That means volatility in markets is likely to increase. But over any meaningful time horizon, Bitcoin continues to act as the best escape valve. Day to day, it is volatile. Decade to decade, it is absorbing massive amounts of capital. And whether the transition is gradual or chaotic, it increasingly looks like we are approaching the final chapters of the modern fiat experiment. Thanks for watching, everyone, and see you next time.